Welcome back to Money Virtue. Today, we will be talking about how to use options to hedge your stock investments. Options trading is widely used as a risk management tool for stock portfolios. Hedging is a method of managing risk that involves making a second, unrelated investment in order to balance out the first's potential negative effects. Option contracts provide the buyer the right, but not the duty, to purchase or sell a specified number of shares of stock at a specified price and on a specified date. Put options are a frequent technique to use options as a risk management tool for stock holdings. The owner of a put option has the right, up until the option's expiration date, to sell the underlying stock at the option's strike price. An investor can hedge against a decline in the value of their stock holdings by purchasing a put option. Suppose, for the sake of argument, that an investor has 100 shares of XYZ stock, which is now trading at $50 a share, in their portfolio. An investor who is worried that the stock price may fall can protect themselves by purchasing a put option with a $45 strike price and a 3-month expiration period. An investor can reduce their risk by locking in a $45 per share sale price for their stock using a put option. This option expires in 1 year. Using call options is another frequent strategy for protecting stock portfolios with options. A call option offers the holder the right, but not the obligation, to purchase a certain number of shares of stock at a specified price, the strike price, on or before a specified date, the expiration date. A trader can hedge their stock portfolio against gains in the stock price by selling call options. Say an investor has 100 shares of XYZ stock, which is now trading at $50 a share, and the stock is expected to increase in value by 10%. An investor who thinks the stock price might climb can hedge their bets by selling a call option with a $55 strike price and a 3-month expiration period. Gains can be realized by an investor if the stock price rises to $55 or more before the option's expiration date, at which point the investor must sell his or her shares at $55 each. Options trading carries a high potential for loss and is not appropriate for all investors. Options trading can be a useful hedging tool, but only if you take the time to familiarize yourself with the dangers and how the system works. If you're unfamiliar with options trading, it's wise to speak with a professional first. To sum up, options trading can be an effective means of protecting stock portfolios. Investors can hedge against price fluctuations in stocks by purchasing or selling options contracts. However, options trading carries inherent risk, so it's smart to get expert advice before jumping in. Therefore, options trading is a potent instrument for protecting stock portfolios. It's a strategy in which investors take on another investment with the hope of offsetting any losses from the first. An investor can hedge against a decline in the value of their stock holdings by purchasing put options. And one can hedge their stock portfolio against price increases by selling call options. Options trading carries a high potential for loss and is not suited for all investors. Attempting to utilize options trading as a hedging technique without first understanding the risks and mechanics involved is a bad idea. Keep in mind the options contract's expiration date and strike price. Finally, before beginning options trading, it is strongly suggested that you speak with a financial advisor or professional to make sure the strategy fits in with your overall financial goals and comfort level with risk. Also, options trading is not a one-and-done tactic. Rather, it requires constant attention and adjustment in response to shifting market conditions. Thanks for watching. Money is happiness. Invest safe. Always hustle love. Money Virtue.